So, hi, good morning to all the participants. On behalf of Prabhudas Leeladhar, we would like to welcome you to this call with Rise Start on oil prices. So, we have with us Mukesh Dev, who has over 3 decades of industry experience in the oil value chain, having held leadership roles at Shell, Aspentech, and Indian Oil. I have been fortunate to work with Mukesh at Indian Oil Corporation almost 3 decades back. He has worked in APAC and US markets for 2 decades, specializing in energy markets analysis, strategy, hydrocarbon management consulting, project management, oil economic optimization, and refining and petrochemical asset operations. He is also joined by his colleague Samrat Guglani, who is the Senior Vice President and Global Business Development Head of India. So I would like to request Mukesh to start with a brief introduction, and then he can dive into the presentation that he has, and then we can, after the end of the presentation, we can take few Q&A. Over to you, Mukesh.
Okay, thank you, Bhushan, and good morning, everyone. Really, it's an interesting time to talk about oil markets. And Bhushan and I were speaking about, I think indeed the title is very apt. It's a slippery slope down to 40s, 50s, everybody is talking about, or what we will call, and the point of this presentation is to give you some thoughts around why there could be a boomerang mode as well rather than a slippery slope. The whole idea for today is to give you not too much of noise in the market around Trump. So I will not be talking too much about Trump. What I'll be focusing on is the fundamentals and what the fundamentals are talking about. And based on those fundamentals is what we will talk about the market, right? Now, if I give you a little bit of who we are as a company and what we want to talk about today, I'll just spend a couple of minutes initially. So we will indeed cover the short-term market space, but Rystad is also known to cover a lot of the long-term market space as well. I'll come back to the agenda. We are a global company present almost all over the globe, and our DNA is to really look at count the barrels, count the assets. So you can see we look at 3,000 assets across the upstream, downstream, midstream supply chain, all kinds of numbers, and a huge sort of a client base. We believe in our CEO believes in building the digital twin of the energy market. So really, our understanding of the whole energy systems from left to the right is quite detailed, quite granular, and that's where we build our entire analysis, as I say, micro to macro. What you're going to see today is two kind of offerings we have in the market, what we call an oil macro solution, an oil trading solution. The macro solution is more for investors, strategists, and trading solution is really for the physical and the paper traders. I believe today's interest is more around the equity and the investor sector. So I'll keep it high level and not go too much into the jargon. So with that, Bhushan, Josh Samrat, you want to say something or I go ahead?
I am good. You can go ahead.
Okay, thank you. So let's dive straight into the view, right? Without wasting any time, I want to give you what is our view, and then I will share a lot of the fundamentals analysis on why we believe in this view. So what you see on the chart is 2024, $80 a barrel, roughly. The market was extremely stable because the market had come out of two big volatile periods. One was the COVID and the other was the Ukraine crisis. And even before the COVID had hit, the market had another big volatile move, which was around the 2018 when there was too much of oil in the market. And then in 2014, there was the shale kind of a boom that was taking place. So one thing which has come very strongly in these times is that OPEC has learned one thing, that if you love higher forever, you will get lower for longer. I'm sure if many of you are in the oil markets for long years, so you will remember the slogan, lower for longer. So OPEC has learned that higher forever is not good, lower for longer is not good. Higher forever oil prices results in member disunity, results in cheating, results in compliance problems. So OPEC has been very deliberate, very data driven these days in keeping the oil prices stable. Now, it's really a commendable thing what OPEC Plus has been able to do, because we have witnessed huge geopolitical crisis. 2024, we had almost 70 elections across the globe. So despite all that was happening, the oil prices was very stable. And I think we will talk about why. And understanding that why will give us the picture into why this year also could there be a repeat of the same performance, or OPEC Plus will actually abandon the philosophy. Now, what you see on the slide is the middle white line, which is our future outlook, that oil prices will probably hang around in this 70-75 range. And what we have witnessed now, that the prices are finding good resistance around the 65 mark. We believe that there is potential from March to August for the prices to come back, and I'll talk about why. Yes, of course, there are situations where if there is a big supply disruption risk, if Iran goes out of the equation, a million barrels get impacted. Yes, oil prices can go to $90 a barrel. If there is a big recession, now the percentage of recession by various banks in the US is being talked around 30%. We are on the 15 to 20% recession risk, not a huge recession risk. But yes, if demand does not perform, then oil prices can also tank to 50s, but that means OPEC will be just spectator and will not do anything. And that's what we don't believe, that OPEC will just sit around and let the oil prices go to the 50s or the 40s or even 60s, I would say. So why is just the flat price the most important thing to watch? Probably who people who watch the market understand that these are the real curves to watch, and the curves are bending. What these curves are, the futures curve of the US WTI as well as the Brent. The upper ones are the Brent and the lower ones are the WTI. The only thing I would want to point out is the curves are clearly telling us, despite the level has gone down, the market is very short. And this is the number one goal for OPEC Plus, is to keep the curves in the backwardation mode, because if the market and the crude structure is in backwardation, the incentive to store the barrels does not exist. And that's what OPEC Plus almost guards like a very strong parameter to keep the market backwardated. And their strategy so far has been always roll the extensions and tell the whole world, we are bringing oil, we are bringing oil. And that view keeps the back end of the curve pressurized and lower, and the front end of the curve up. Market stays in backwardation, and nobody stores oil. And I lived in Houston, Texas for many years working with Shell Trading. The number one thing the traders always loved was the contango. Then the Cushing barrels, the US Gulf Coast, can store a lot of barrels and play the seasonality game. So watch out for backwardation more than the flat price. And this is a true measure of the market being tight. And this clearly shows the market is tight. Now, let's dive into some of the basics, but I will also provide a lot more flavor on these numbers. So what you're going to see on this screen is the oil demand outlook. We talk about oil demand, which includes distillates, gasoline, NGLs, naphtha, jet, fuel oil, and then there are other components. So those numbers add up to almost 104 million barrels per day. And we are saying that we came out of the COVID era, and probably in 2023 we almost back to 2019, some growth in 24, and now we are talking about a million barrels growth in 2025. Now I'll show you in next slides where is this growth going to come from and what is really at risk. It's very hard now to pinpoint how the tariffs and the sanctions will affect. For now, we believe the tariffs and sanctions are more a supply sort of a risk problem versus a demand risk problem. But yes, even if Trump does deals and negotiations happen, some permanent damage sort of, at least for the short term, is done. And what that means is that maybe out of this million barrels growth, which is not bad growth, it's a decent growth, maybe we can shave off 300, 400 KBD of the growth. That growth is likely to be shaved off from the sectors, from the naphtha, petrochemical, and the jet market sector, whereas the road transport sector actually might perform better. So if you're watching those companies, those stocks which are more petchem oriented and airlines, I think those are the ones to be worried about. Now let's keep going and look at some more numbers in the same picture. Where is this growth going to come from? So if you look at distillate growth, Asia is the biggest, and gasoline, Asia, North America are the biggest, and now of course Asia is even higher than North America, and Europe is almost half or somewhere, and then rest of the countries are in the smaller numbers. So scale matters, even if so that's why North America and Asia, particularly China, matters a lot. Then we have the NGLs, because Asia is very petrochemical driven. China has built huge amount of petrochemical plants, and everybody understands that as the energy transition accelerates, it's the road transport demand that will go down, but the petrochemical demand will go up. So industry is really getting ready to even convert crude to the petrochemicals. That's why you see the growth in the Asia sector, is kind of a growth period, whereas North America, Europe are kind of flat. If we add on top naphtha, which is another big petrochemical feedstock, you can clearly see Asia continues to grow, whereas Europe, North America are flat. Add the jet demand, then fuel oil, and then some other products. So it's clearly a story of whether Asia and Middle East also is growing. Can both of these regions save the day and prevent a big demand shock in the world? That's the question we will look a little bit deeper. The answer is probably no. And the reason is that China is not for the first time seeing these tariffs and sanctions. China is putting a very strong retaliatory approach, which means that if the tariffs which Trump administration has put, China knows how to deal with it. China has prepared for many years. It's not the first time. Even Biden era was a lot of tariffs and sanctions. So China is well prepared, and China has, I believe, hedged quite a bit of the market. And now, of course, there is more stimulus that is going to come from the government if they have to protect the Chinese market. So not so much, I would say, demand risk. There are a lot of people in the market who are talking about 1 million barrels per day of demand will be evaporated and we are doom and gloom. We don't believe in that scenario yet. The only thing which will really get affected is the jet market, because the international travel is affected, and also the cargo, the maritime sector, because of the trade flows, will be affected. But we are also seeing signals that every country will be more scared. So there will be more balancing within the country, within the states of India, within the states of United States. There will be more supply demand balancing taking place, and there might be an impetus actually to the road transport rather than the other way around, because it might be costlier to import on the coast from a foreign country. It might be better to buy long distance, probably within the country. So some interesting dynamics will come at play, where jet and maritime will come under check. Petrochemicals will also suffer, because now petrochemical, which is China driven, is the key thing, whereas diesel and gasoline there might be some surprise that they hold the game. Now let's look at this picture in another angle, and this angle is a little bit of a history, that if 2017 is 100, how are we looking like across the product space, across the region? So clearly, again, Asia is way higher, and there is a dark line, the orange line in between, which is Middle East, which is again very strong. And then you see Russia actually is going down. There was some demand growth in Russia because of the military and mobilization. As some ceasefire takes place, Russia probably will suffer 200 to 300 kbd of demand loss, whereas all the other regions in the world are more or less flat at the moment. Now this is assuming 15 to 20% recession risk. This is not assuming a big blown recession risk, which we don't believe as yet. Now, on the right-hand side, if you see those charts, the top line is the NGL, which is the natural gas liquids, which is a petrochemical feedstock. The next blue line is also naphtha, which is also petrochemical feedstocks. And then you have the green line, distillate flat, gasoline sort of a flat. And the line which goes outside the chart is the jet line, because we had a big jet shock in the COVID. And I will say jet lag, jet is not yet out of the lag. And we were hoping that by 25, 26, everything will recover. But because of these tariffs and travels and all those situations, so these are the sectors which might be affected. And our numbers indicate probably out of 1 million barrels growth, almost maybe 200, 300 is at risk. No, not more than that as yet. So that's the demand side of the story. Let's look at the supply side of the story. And I think it's big story on the quality side rather than the volume side. So as you can see again, the world recovered from the pandemic, and we have seen the medium SAR barrels, the orange, the second bar is where the cuts have taken place, but the light sweet barrels from US have gone up. The non-crude, which is the natural gas liquids, have gone up. And then the category called the heavy SAR. This is the category heavy SAR, which has come, I believe, in the biggest danger with sanctions and tariffs on Venezuela, Mexico, Canada, Iran. This is where the heavy SAR barrels industry is actually much in trouble. And we believe that Venezuela, if the licenses for Chevron is not extended going forward, we might lose quite some significant production, and Venezuela can come down below to even 500,000 barrels per day from 1 million barrels per day, which they are producing right now. Yes, Venezuelan barrels are kind of loan China, so they don't have to pay. So China probably will keep on buying Venezuelan barrels. So roughly, we could lose some production there. Canada goes into big maintenance in May and April and June periods. Norway goes into May, April, and June period. That is the why reason we believe that OPEC Plus has taken an opportunistic move, because they know that now the non-OPEC producers are going into maintenance, the heavy SAR ones, and let's bring some barrels back. So it's an opportunistic move, and don't believe that OPEC Plus can continue to add the barrels sort of the going forward. Now, the medium sweet barrels is the Brazil story, and Brazil promises a lot but doesn't turn out as good of a production profile. So there is some risk to the Brazil production as well. So overall, I would say that the light sweet barrels is growing, which the world does not want. The non-crude liquids, the NGLs, is growing, what the world does not want, because the petrochemicals is what is needed, requires the light sweet and the non-crude liquids. The world needs the medium SAR barrels, which the OPEC Plus, and the heavy SAR barrels, which is in good control. So volume-wise, we might look okay, but quality-wise, we have a challenge. So let's look at another angle. Where is this happening? So as you can clearly see, Middle East, flat crude, some NGL growth, some condensates. They have been adding more condensates than probably crude oil. If you look at North America, it's the crude oil, which is the wrong quality, light crude oil. It's a very strange situation that American refineries are all very, very complex, but the crude they found under the ground is the wrong quality. They needed the Canadian heavy barrel, they need the Mexicans, they need the Venezuelans. So a lot of the crude has to get exported. And the US crude is a bad crude to make gasoline in the market. That's why the European refineries are under quite a lot of struggle. And then you have a lot of NGLs also coming to the market. So yes, the US is adding a lot of barrels, but these numbers then sometimes cloud our judgment sort of on the supply demand balances. Uh, Again, if I look at from the quality angle, as you can see, Middle East controls the best barrel, which is the medium SAR barrel. Middle East also controls the heavier barrels as well, whereas North America is the light sweet barrels, and the North America is also the non-crude liquids, which is the wrong quality of the barrels. The US refineries cannot run these barrels after a certain point. Maybe 8 million barrels per day, 8.5 million barrels per day is what they can absorb of the total production of 13.5 million barrels per day of crude and condensate. So these are the difficult barrels for US. Now, these are the barrels, the NGLs, the LPG, the ethane, the propane, the butane, which China was importing a lot from the US. And I think US thought that China will not retaliate, because if China doesn't get hold of these petrochemical feedstocks, then China is in trouble. But China has been changing a lot in their refinery systems to make more naphtha feedstock so that they can run and make more petrochemicals. That is why they have been able to put a 34% retaliatory tariff. And this causes, it's not China who's played it wrong. Actually, probably it's Trump who's played it wrong, thinking that China will be really in a dire strait. So this is where the US problem lies. Now, if we keep going in another way to look at the US specific problem, we have been hearing these slogans, drill baby drill. Then we heard about the fill baby fill, because the strategic petroleum reserves in US are almost, maybe I would say 40-50% mark. So probably the wrong crude oil is stored again. It's not the medium sour barrels. And they want to fill the strategic petroleum reserves. They want to drill more. But the true story is that the US problem is more of a blend, baby blend problem. That's how I describe it. And what it means by that is that if you look at a long history from 1996, if we take all the numbers as one and draw these charts and graph, you see a lot of lines in the middle hovering around one, which means that neither US has built more refineries, US crude oil refinery input has stayed the same. You can see the distillate stocks are down. You can see the crude stocks are down. So all the stocks are down, but US has too much of the light crude oil production happening. And what US was doing was, by producing the light barrels and by blending with the heavier barrels from Canada and Mexico and all those places, they were able to reduce the import of the Middle Eastern barrels. Now, if they don't get the Canadians, if they don't get all these barrels to them, then they will not be able to absorb the light crude oil. And this crude oil then has to face a pressure, and supply may not come strong. So we don't believe that US will come back and build 1 million barrels of supply every year like they have done in the past. Probably 500,000 barrels is an optimistic scenario. So we don't see too much supply either coming out of the US. So I have talked about big picture on demand, supply. Let's look a little bit from the angle of OPEC and non-OPEC and look at the balances so that you can get a better sense of the price view. So this chart shows the growth. So as you can see in 2024, the blue, which is the OPEC, has been cutting the barrels, and the non-OPEC has been growing and growing and growing and taking the market share away. Now in 2025, there is non-OPEC growth, pretty sizable if really it all that happens. Whereas if we go by the announcements of OPEC, they were earlier planning to bring only 150,000 barrels per day every month. In the month of May, they made it 3 times. So you can add a little bit, 200 KBD here, not a lot. But overall, it's the non-OPEC supply which is coming strong in the world. And that's where OPEC has to play a different game. They cannot play a flat price game. As I talked about the demand growth, I showed the numbers. These numbers are not bad. In the past, 2019 was 1 million barrels per day. Average demand growth over a long period is 1 million barrels per day. The only difference is that in the past, the demand growth was a lot driven by the distillates, driven by the gasolines. Now the demand growth is a lot driven by the lighter end of the barrel, which is the jet, which is the naphtha and the NGLs. And these are the ones which will get affected by tariff. So you can shave off about 200 to 300 kilobarrels per day of the product demand. But does it mean that the oil prices will go down? The answer is no. And why I say so, because we have been looking at the wrong way. So what I'm going to show you now is the wrong way to look at the market, which is year-on-year numbers, right? So we all know that 2020 we had a COVID crisis. Then there was a big jump in the demand. The supply didn't come back as fast. The refineries come back fast, but the crude did not come back. And then you had the Ukraine crisis, so we had higher oil prices. And then gradually in 2024, we saw that the supply was being cut. The crude and condensate was being cut. There was demand, not a huge. And now in 2025, we are clearly witnessing too much of liquid supply, too much of the crude supply, liquid demand is less, and even the crude demand by refineries is not sort of a huge. Now, what I'm showing you is the year-on-year numbers. And I believe the year-on-year numbers make only sense when it's a normal year. It's a Trump 2025, which is absolutely not a normal year. So I would say these way of looking at the market is absolutely not going to derive any help. The right way to look at the market is what we call March to August. This is the seasonal demand growth period. And if you look at the long-term historical period, this is where the demand always grows. This is where the crude supply grows. This is where the refinery runs grow, because from March to August, the summer comes and everybody wants to go on vacation, driving, and other things. Now, if you look at 2025, there is a liquid supply and liquids demand. It's not as bad as in the previous chart, where you see there was a much bigger gap on an year-on-year basis. But if you look at the same picture on a March to August basis, we don't have that big of a problem. But if you look on the crude side, the crude growth based on what non-OPEC is going to produce, because April, May, and maybe June, Canada is going into maintenance, Norway is doing, Brazil may also struggle, and Brazil will struggle because the medium sweet quality barrels, who was buying the barrels from Brazil? A lot of the barrels were going to China, and China is not buying as much as barrels. China was destocking a lot of the crude oil. So even if Brazil can produce a lot of barrels, it does not mean that China will easily buy those barrels. So we have actually a shortage crude problem from March to August, not an over surplus problem. And the refineries are hungry for crude oil. And when the maintenance happens and things come back, then we will see that refineries will be seeking more barrels. So this gap is what I will say we need to focus on. Now, let's say there is more pressure in the market. There might be more supply, which OPEC can bring. Yes, OPEC can bring supply more, but then they will kill the price to very low levels. And if they bring the supply too fast, then what I showed you, the market can flip into contango. And once the market flips into contango, then game over for the OPEC, because then the traders will control the market, not the producers. So right now, the producers are in sort of a little bit more control. So is there a risk to refineries? Yes, there is a risk to this tower coming out somewhat lower. But I believe that we are living in a very energy anxious world. It's not security. I would say we have an energy anxiety problem, at least in the Trump era. So every country, even if their demand is not bad, they will try to run hard their assets so that they can stock up the barrels. Who knows what can go wrong? There could be a military situation, the war can break out. So everybody will be preparing themselves more. So the crude demand, I believe, in the world could be actually higher because everybody wants to run more to store up or to prevent any surprise stockouts and challenges if there is a big supply disruption, if Iran and US get into a wrong footing. So this means that everybody will actually, even if demand is bad, everybody will actually ask for more crude oil. This is one of the fundamental reasons why we believe that the oil prices probably are bottoming out, and we should see from March to August, the prices should come back up again. Now, let's look at another very interesting dynamics where I want to point out a kind of a view where what I call that the oil circularity in the Middle East. Now, what oil circularity in the Middle East means? So the left chart shows you the capacity oil refining growth. Here you can see that if 2015 was 100, Middle East refining was not growing, and then you see a huge bump in Middle East refining. China refining has always been growing, but Middle East growth has even taken over China. Africa with Dangote refinery and some others is also showing quite a big move. And then the global, we are kind of similar place because Europe is down, Russia is down, North America is down. So a lot of these countries are actually on the refining attrition mode, whereas Middle East has been building big oil refineries. Now, what that means is that what I call downstream is the new upstream for Middle East. And what they have been doing is, yes, they have been cutting the crude oil, but I believe they have been pumping a lot of products to the market. So on the right-hand side chart, you see the product exports growth. Now, Europe stopped exporting the barrels because they lost Russian crude, they lost Russian products. So Europe was in a big trouble, right? So Middle East and Asia has taken the advantage. And we all remember that the refinery margins and the product cracks touched $50, $60 a barrel. That was the best timing for the Middle East. Ukraine crisis was the best crisis for the Middle Eastern refining to come online and scoop all the margins. So it's not that the Middle East is losing money by selling less crude oil. The Middle East is actually making a huge money. And now think about it that in the past, Middle East had only one pedal to the car. To if you want higher oil price, cut crude supply. If you want low oil price, bring crude supply. Now, sometimes if you drive the car with one pedal, you get it wrong, and that's why we land into sometimes oversupply and undersupply positions. The big reason why this time the OPEC in the Middle East has succeeded is simply because they have the second pedal in the car, which is the product side of the house. So how it works? You remove crude from the market, and the oil prices can start going up and up and up. And if the oil prices touch 90s, or every OPEC, at least Saudi Arabia, starts to worry a lot. And why Saudi Arabia worries? Because they know the moment prices go high, Iraq, Kazakhstan, everybody will start to cheat, and they will leak the oil to the market. So a high oil price is very detrimental to the member unity. The higher oil price is very detrimental to the to a cohesive system. So they needed to find a way to put a check on the oil price without bringing more supply, because if you bring more supply, then the market goes to contango. So the best tool in the town was the products. So you remove oil from the market, create some crude hunger, and then pump products into the market. Now you can imagine giving crude products to the market is as like giving crude to the market in a different format, and there is no OPEC quotas on the product side of the house. So they can check the oil price spike by pumping more products. They can check the oil price slide by cutting the crude oil, and that is what they have been doing extremely, I would say, efficiently in a very carefully calibrated manner. And we have also seen that China's product exports have actually sort of come down, because China is also rationalizing a lot of refineries towards the petrochemical for the future, rather than just make the diesel and the gasoline for the market. So this phenomena is another important reason why we believe that the oil prices will probably hang in and come back and not go to 50s or 40s, because 50s and 40s is not useful for pretty much anyone. Now, I've talked about why OPEC can handle this. Now, the key question that comes in the mind is that if can there be a 2018 scenario? And what was the 2018 scenario? 2018 was that everybody thought that the US shale will not perform because US had a lot of pipe problems. Evacuation of the crude oil from the middle of the US to the Gulf Coast was a big problem. And I was there at that point of a time, but we all remember 2018, US production grew by almost 1.5, 1.8 million barrels per day. The crude was flowing on pipeline, the crude was flowing on rail, the crude was flowing on trucks to the Gulf Coast and get exported. And then there was Iran was sanctioned, and then Trump gave a waiver for Iran. So Saudis and OPEC also brought production in, and then there was a waiver. So there was a perfect storm where Iran came back, US produced a lot, and Saudis and OPEC also produced a lot, and demand was okay. And that's why we landed into the 2018 December, kind of a price crash. We don't believe we are in that times, because OPEC has learned once that they just will not toe 100% the line of the US. Yes, they might calibrate a little bit the oil prices, but they won't be letting the oil prices tank. And if there is a big disruption from Iran, yes, OPEC Plus has the spare capacity of 5.8 million barrels per day. So they can handle any disruption today, and they will not let the oil price go up, because a higher oil price again disturbs the member unity, compliance, and above all, destroys demand. And we are already in a precarious demand situation. So we should not expect any higher oil price. Now, as I talked about, could there be a scenario where Russia is ceasefire, Russian barrels start flowing to the market? Let's assume Trump does all the deals, with deal with Canada, Mexico, Venezuela, Russia, and resolves every deal, and also a deal with Iran. Will there be a flood of the oil and the oil prices can go to the 40s and 30s and 50s? The answer is no. And the reason is Russian exploration industry is extremely hurt at the moment, and they may not be able to produce a lot of the barrels. Now, Russian crude is now tariff, as Trump, don't buy Russian crude oil, because Russian refining is also under trouble, because what will happen is Russia will likely run the crude oil in their country, and because their demand will go down, Russia will try to pump more products to the market. So let's watch out whether what happens with Russian products. Will Trump go and tariff the buyers of the Russian products as well to put a pressure if the ceasefire does not happen? Overall, Russia is in a very, very weak situation. US has the cards, not Russia. I think Trump was not wrong when he sat down with Zelensky and said, you don't have the cards. That is actually the reality of the game, that US has the cards. So Russian production will not spike up, maybe 200. And the big question is Russia will not violate the OPEC plus group as well, because once they go out, then they are in a big trouble, because now Russia competes with Middle Eastern barrels in the same Asian market. Let's look about Mexico, south of US. Mexico has a lot of debt problem, investment problems, and they recently had a big problem with there was a huge water system, and they had a big problem with their crude oil. They had quite a lot of water in the crude, and they destroyed their own refineries as well. And I think a lot of big refiners in India, one of I know, they were very much worried about what happens with Mexican barrels. So from that perspective, Mexico, not much. Venezuela, I believe, not much, will stay challenged. Now, Canada, we also feel Canada can pump a lot of barrels towards China. China and Canada are probably shaking hands. And in that scenario, I believe Canada also cannot pump too much oil towards China, because at the end of the day, there is a limit to the pipeline capacity. And we just learned recently that they cannot bring too much capacity. They were trying to put some mechanism to increase the capacity of the pipeline, and they cannot. So bottom line is the Canadian crudes has to go to the US. There is no other way out. Yes, few months here and there, they can try and negotiate and do a turnaround and talk tough. But at the end of the day, Canadian oil will still go to the US. If it doesn't go to the US, and US will not allow everything to happen, the Canada way. So neither Mexico, neither Canada, nor Venezuela, nor Russia will be able to bring, if the world comes to a peace, bring a lot of barrels back. That brings down to Iran. I think that's where the biggest challenge is. And our view is that Iran is just a negotiating tool between China and the US. And we have to wait and watch what happens. Iranian barrels probably are all going towards China. China might still be able to buy and get some better discounts again, or there might be more floating storage happening in Iran to manage the day. Overall, I believe, and we believe, that there is not a lot that can come out of Iran, because Iran is not operating at very low numbers. Iran is already back quite a lot of production. So there's not a lot more. Suddenly a flood can come from Iran and tank the oil prices. So from a supply side, all the parameters point out towards that even a peaceful world does not mean huge oil supplies. The control remains in the hands of the OPEC plus, and that is why we believe the oil prices will sort of stay stable. Now, Bhushan, maybe before I go to the China a little bit more deep dive, it might be a good idea to take some questions here, and then I can talk a little bit, few more slides on China.
Sure, sure. So, participants, if you have any question, either you can write in the chat box or you can raise your hands also, and I will unmute you. In the meantime, Mukesh, we had one question where the participant wanted to know a little bit more about the current maintenance season that we are having in terms of crude oil supply. So, if you could give some more color on that aspect.
Okay, so you mean the Canada, the Norway kind of a numbers?
Yes, yes, yes. So,
Okay.
like you said that heavy SAR, we are seeing that some maintenance is going on because of which OPEC has done opportunistic move of releasing more barrels.
Yep. Okay. So I'm now opening our internal tool because I believe in numbers and I can show some easier way, a little bit more data points to you. So give me 1 second so I can make these things a little bigger for you. Okay. What you're looking is our global supply sort of a database. And here you can see this is the global numbers. And if I split this database by the OPEC and the non-OPEC barrels, we will clearly see how these are sort of subdivided. And it is in the non-OPEC where we have a lot of the maintenance coming. So if I double click on the non-OPEC and split this data by countries, we will quickly see that Norway, Canada, this is where the maintenance cycle is going to come from. I can also quickly show you, give me a moment, yes. So here you can see US and Canada. If I double click on Canada, Canada goes into about 300, 400 sort of a maintenance period in May. So you can see here, Canada was producing, let's say in March, around 4.95 million barrels per day. That's what they have been producing in the past. And if we go back and look at, let's say, a much long-term history of Canada, this is the kind of the numbers which the Canada has been operating, and this is their seasonal profile. So about 400, 500 KBD Canadian production can go out of the game, and this is where that I would say, where is 20? Maybe let me remove the future years. Yeah. This is where I believe that OPEC has taken an opportunistic move to bring the barrels back. Now, this is Canada. We can also look at the same chart for Norway. So we will see that Norway also goes down, and there are other countries like UK will also go down. So Norway, May and June numbers for Norway are also down. And then you will have these projects also come back upon. So in some ways, I would say that yes, there is quite a lot of maintenance happening in many parts of the world during this time around. And that is the reason why we believe this is a bit of an opportunistic move rather than they can keep doing if the demand after August, it would be extremely hard for them to bring the barrels back short to the market.
Thanks, Mukesh. So, participants, if you have any questions, you can raise your hands and I will unmute you. Or then otherwise, Mukesh will proceed to his further discussion. So, we'll wait for 30 seconds.
Okay. I'm also showing what is our Bhushan, our entire portal where we provide all the market views for all kinds of industry segments. I'm focusing on the oil markets, and let me pick one of the latest notes which we had written about like the Venezuelan crudes, for example, just to give you an idea why we believe strongly that the market is probably too much worried about demand, but they think supply. So this is clearly a different scenarios where, as I was saying, that the Venezuela crude production can fall down to almost half of 0.6 million barrels per day from the 1+ million barrels per day they were doing if the Chevron license is not sort of renewed. So, and Venezuela has quite a lot of debt crisis, and the Venezuelan oil refining system is not the ones. Whereas if Middle East, if they produce less crude oil, they can send the crude oil to their oil refining system and make products, but not Mexico, not Venezuela, not Russia, not Canada. Their refining systems have been traditionally very small, not complex, weak, and that is why they can only produce crude oil. Middle East is where they have done the amazing work, I believe, by building refineries in Kuwait, Oman, Zizan, UAE, and all those refineries are the most modern refineries. That is why Middle East has the highest leverage to manage the crude market, the product market. And I would say that if we'll really go a bit more longer term, let's get ready that there might be an OPEC of products. Right now, there is an OPEC of crude, so there could be an OPEC of products coming to the forward market when the demand declines. So we don't believe that the oil prices and the diesel gasoline will go to the tank when the energy transition accelerate. It will be a managed market, which OPEC has been doing. Okay.
Sure, Mukesh. So there was one more question where you basically touched upon the quality issues of Mexican crude, where water content was higher and their own refineries got affected. So could you elaborate a little bit as to, is this a one-off kind of situation, or do you think that this is a sort of a longer lasting quality issue of their crudes?
I would say that this is a bit more longer lasting. Let's look at this detail. And the reason is that their declines are happening in Mexico quite a lot. So let me show some charts and graphs here. 1 second. Yeah. So if you see, it's the heavy sour barrels which have been in a perpetual decline in Mexico. And what Mexico has been doing is the declines are rising. So they are using some enhanced chemicals, some recoveries, and through that process, they ended up with a water problem. Now, they can solve the water problem by doing more horizontal drilling and other kind of things. But we don't believe that the Mexican problem is actually quite a grave problem. Let me find some slides actually on the Mexican side, and then I can show more. Overall, this rapid salt sort of rapid depletion there is in the mature oil fields, it cannot be reduced or it cannot be recovered or some work cannot be done so easily on that side. So now refineries will be much more worried. That's why we believe the Mexican crude imports of a lot of these grades had fallen down. Yes, Mexico is trying to say that we will take care of it, but we believe it's not going to be easy game because of the capex requirements as well.
Sure, Mukesh. So now we can go into the further slide on, I think, China that you wanted to touch upon.
Okay, give me 1 second. Let me bring the slide back up again. Okay, so let's look at maybe I'll describe first and then probably, China's, we track a lot of real-time activities, right? So China is kind of in a tit for tariff play mode rather than bulking mode. And if you look at the active indicators of the road in China, you look at the activity indicators for the aviation in China, probably it might be a little hard to see here, but this is the purple line. So China has been doing pretty good in aviation recovery. China had in the past some another tariff situation, then they recover fast. So one thing is very clear that China kind of recovers very fast as well when you land into these problems. And this time China is, I would say, better prepared. Yes, China may need more boost to the market. So if you look at their PMIs indexes, they were quite volatile in 2022, but the PMI indexes now they are kind of above 50. So China has learned to, and the Biden era was not like the non-tariff era because Trump had put tariffs in his first term, and those tariffs never got removed. So China has learned to pivot away from these. Yes, we will see, certainly believe that the export values from 22, 23, 24, and 25, China will find, I believe, better options, other countries. Now, one interesting thought I have, and I have done not deep analysis, is if US only sanctions, let's say China, that's one situation, because the pressure that comes, some other countries, Vietnam, Cambodia, India, will go and sell into the US markets easily. But if US puts tariffs on everybody else, actually it gives China a better competitive situation, because now the countries which could have taken an advantage because of the tariffs from China, they are also under tariffs. I mean, we have seen Cambodia, Vietnam, and all those countries come under tariffs. So actually, China might do better, and China has deeper pockets than the Vietnams, Cambodias, and all other countries. So China might actually absorb some of the cost and still might be able to push stuff and quantity into the US market despite the tariffs, whereas other countries will not be able to do. So overall, we believe that China in some ways is a better prepared China, and now they are planning to do a 4% sort of a GDP deficit to stimulate the economy. And China has also rationalized quite a lot of their systems. They are closing down some of the teapot refiners, but they are moving towards the petrochemical refiners. They are moving towards refineries which make more petrochemical feedstock versus fuels, because China has done wonderful thing in the EV market. So if I can show you maybe what is the view on the EV side of the market. Give me 1 second. China is really driving hard, and what China has done is that China has, okay, yes. China has actually done what we call coal-fired Teslas, right? Because they can generate electricity from coal, they are a developing country, and because they are a developing country, they have the offsets. So if you see, the entire EV situation so far has been a Chinese story. Yes, we have seen some months of challenge, but now again, if Tesla gets into trouble because of other reasons, this is another, again, an opportunity for probably the Chinese sort of a market. Yes, we have seen a bit more down. This means that Chinese EVs, which were not selling in other parts of the world, might be selling faster in China at a cheaper cost. So China might actually go and do a bit more of faster energy transition. And that is the why reason, if you have caught the news, Trump was also saying that US needs to fire more coal, because by generating electricity and running the cars, you can imagine that you are not buying a very expensive crude oil. And also, China has benefited for the last 2 years, and China and India also have benefited from the lower cost of the Russian discounts. So there has been quite a good stimulus to their economy. They have made and saved a lot of wealth, which otherwise would have been spent. So in that way, LNG trucks in China, that's also a big thing. And that LNG trucks is driving quite a lot of the demand in China. So maybe let me show you that. So overall, the kind of the picture I'm painting is that the China has found ways not to buy more crude oil and still move things on the ground. The only thing China cannot do is jet, but jet demand is also, I would say, China is not a big. So here you can see the LNG trucks percentage, these blue bars, has consistently increased. And if the gas prices are favorable and the LNG is favorable, then China runs these kind of a fleet, and this also helps them, let's say, reduce dependence on the crude market. So in some ways, I will say that China has better prepared their road sector. China has better prepared their refineries and a feed prep unit for the petrochemical market. So all in all, we don't believe that China this time around is in trouble. And the other thing which I can show very quickly is that if you look at the global oil demand, this is the global oil demand. And if I just zoom into China as a country, the point I want to make is that it's not that China was growing at 8% and the demand growth in China was very, very huge, that now these tariffs will have a big impact. Yes, China was growing in 2016, 600, 700, and then, of course, 2021 and 2023, China is already at 200 KBD growth. So how much more you can kill? It is already down to a very low levels. If we were here and then Trump puts tariffs and sanctions, that this can kill Chinese demand. But otherwise, we don't believe that this can happen. Okay, so I've touched upon China kind of painting a bit more resilient picture. Now, the only assumption I am making here is that probably these tariffs and these sanctions, how long Trump can last with no deals, right? How long US can afford not to have a deal with Europe, not to have a deal with China, not to have a deal, and then it might become unsustainable for the US markets because the manufacturing in US will take some time to respond. And I guess summer is the biggest period where we believe that if there is a situation where the oil prices go back up again and the pump prices are higher, that's where Trump has to do deals before the summer, or Trump has to twist the arms of OPEC Plus and bring barrels more to the market while Trump is taking chances. And the other reason why Trump is taking chances, especially on the supply side, is because Trump knows that OPEC Plus has the spare capacity of 5.8 million barrels per day. So he is playing from that perspective because the market, otherwise, if there was no spare in the OPEC Plus and US cannot produce more, Trump will probably not take the chances on the supply side because then the oil prices will shoot up. And when the summer comes, then you can lose the midterm elections, and not just the midterm elections. We already know a very popular candidate in Wisconsin, which Elon Musk put quite a sizable amount of money, has lost. There are protests in the US. So I guess there is a limit on how much this game can be played in the US. And if it goes beyond the summer, then I will start worrying about China and the overall global recession. But for now, I would say March to August is what is the period we should all be focused on. Okay, I guess I have touched quite a number of things, Bhushan, but happy to take more questions.
Sure, sure, sure. Thanks, Mukesh. It was really very insightful. Quality over quantity, and the role of how heavy or deficit of heavy sour crude in the markets is going to basically push oil prices. So thanks a lot for your insights. I would let's just wait for some time if participants have any questions. So, participants, if you have any questions, you can raise your hand and I can unmute you. You can go ahead with your question, or you can type in the chat box as well. So, in the meantime, that we will get questions from the participants. I had one question, Mukesh.
Mhm.
When Trump came into power, I think he has also allowed the drilling in Occidental offshore continental shelf. Do you think that that would be helping in bringing not the light sweet, but other kind of crudes to the U.S. Production portfolio basket?
Yes, so I think the medium sour barrels, probably some barrels will be coming, and I can show those numbers. Give me a second. Let's look at US as a country, and let's split the data by the quality of the barrels and essentially the supply segment. So this is the entire US sort of a profile. And if we look into its asset, the number one thing which we should worry about the US production, whenever we talk about the US production, is this picture. And what it means is that if you look at the decline curves in the US crude oil, these are always very, very high. I'll show you the same chart for Saudi Arabia, and I'll show you the same chart for the US. So one thing is that if a well which is producing in March or April, if we don't do anything in US from 13.4, this is everything. Let me only look at, yeah, this is crude and condensate. From 13.3, we can easily go down to 10.1. So we can lose big numbers if we stop drilling. So even to keep the things flat, US has to work extremely, extremely hard. Let me show the same chart for a country like Saudi Arabia, which is not exposed to this kind of a problem, uh, other than their cuts. Okay, let me see. Other than their cuts and voluntary things, we will notice that the decline curves in the mature Middle Eastern is not really there. So they don't need to do much to keep the production going, whereas US has to do a lot to keep the production going. That's the point number one. The point number two is that the shale plays are getting much, much more lighter barrels in the market. So it's like I would say that the shale plays are lighter and lighter. It's the Gulf of Mexico or Gulf of America, whatever you want to call it. That's where the I would say the right quality of the barrels will be there. So if I look at the percentage of the total barrels of from a supply segment perspective, what I can show you is that it's predominantly the light sweet barrel. Let me do a percentage game here. So here you can see it is 72% light sweet barrels, which the US produces, the shale. Then you have the offshore deep water 13%, and then you have the other onshores. Now, if I plot a different way this line, we will clearly see what sort of yeah, so you can see that it is the shale which has been increasing. It is the onshore which is declining. So if your question, Bhushan, was on this offshore kind of a segment, yes, let's look at a little bit more history of these numbers and how the picture look like. It's not that, yes, we had a peak of about 2 million barrels per day. Sorry, no. This is the peak it can touch 2 million barrels per day, maybe by end of the year. So yes, there is some growth in these numbers, but I would say that this is not where the massive play is actually happening. So if I look at on a year-on-year basis, we are looking at a growth of let me do the numbers. So we are looking for a growth of what, 120 kbd maximum.
Sure. Thanks, Mukesh. We just have last couple of minutes in case any participant wants to ask. You can raise your hands, or you can type into the chat box, or in the interest of time, we would end this session. So let's just wait, Mukesh, for 30 seconds, and then we can take a part.
So maybe if maybe I'll end on this note. What I call the 2025 is a tipping point year. 2024 was a turning point year. And one chart to kind of close off is that in the past, to forecast the demand, you can take a ruler and forecast the oil demand. And if you look at the history from 2012 to 2018, a straight line, and if you draw this straight line, you would have got oil demand to in 2050 by these numbers. Now, whether you believe these numbers here or not, what is very, very clear, there is no business as usual scenario. There is no straight line in the world. Because of the COVID, because of the crisis, today in 2024, we have already lost fuel efficiency, ways of working of people, higher EVs, and whatever things you can put on. We have already lost 4 million barrels per day of demand gone from the world, right? Because there is a big transition that has taken place in the power sort of industry for sure. All the trillions of dollars which has gone into the renewables has done something. And this chart clearly shows that we have lost 4 million barrels per day of oil demand. Now, supply capacity in the world is not what we have lost. So that is why we believe for some years to come, the supply line is above the green demand line. And this is demand line is also something we have stretched forward because of the policies. So it's not like demand is falling off the cliff. maybe somewhere in middle 2030s is where the demand will peak. And then we believe that the investment in the cycle in the upstream will go down. And what will go down is not OPEC, it is the non-OPEC production that will start to slide fast. And then we might be back into a scenario where the demand is higher than supply. So our view is that for some years, oil price will go down and then the oil price will be back up again. And in some ways, it is the non-OPEC which will fall faster than the OPEC production, but that's too long term. And I'm not sure I'll be there to see that day.
Thanks, Mukesh. It was really insightful, and I think last question, which was there in the chat box, we have already answered that demand has got more setback from your fuel efficiency norms and renewables rather than anything else, and it has already wiped out 4 million barrel per day of demand from the market. So thanks a lot, Mukesh. It was really insightful. Even after I have been looking at the markets for 30 years as well, but it's really insightful. Thank you very much for your time,
No,
and
pleasure.
we wish you good luck. And
Okay.
thanks to all the participants as well. From Prabhudas Leeladhar, we sign off now. Thank you very much.
Okay. Thank you,
Bye.
Bhushan. Bye-bye.